Hey crypto friends, my name is Garrett and I am a crypto day trader who loves helping others with their trading. And in today's ultimate EMA crypto trading guide, I am going to be showing you guys how to use the absolute most popular EMAs and how you can benefit from using them in your own strategy as well. Now, for those of you who love trading crypto and would like to try out the same exchange that I use on a daily basis, feel free to go ahead and try out the Blowfin exchange here with the link in the video description down below this video. I personally love this exchange because they allow anybody from anywhere to be able to sign up and trade crypto futures. So if you're from the United States like I am and you want to trade crypto futures, you can do it right here on the Blowfin exchange. All right, guys, so when we are talking about moving averages, they basically smooth out price data over a specified period of time to help traders identify the overall direction of a trend. And in this video, or this specific video, we are going to be solely focusing on the 20 period, the 50 period, the 100 period, and the 200 period EMA. All right. Now, how to add these to your chart? It is very, very simple. You just go to your top of your chart up here, up to indicators, and you can just type in EMA. And what you want to do is scroll down, and to get all of them that I'm talking about in this video, which is the 20, the 50, the 100, and 200, you can click on this one. It's by a dude named Dr. Sweets. I think he's a dude. I'm not sure. Yeah, you'll just click on it and it will add it to your chart, and it will show up kind of like how mine does, but it might be a little bit of a different color, and it might be the lines might be a little bit thinner as well. But this is what your chart should look like with your EMAs added to your chart. All right. Now, the thing here is each of these EMAs has a specific role in helping you read the market. So you want to be thinking of them as layers of insight into price action itself. From short-term fluctuations all the way to long-term trends. Now, the 20 period EMA is best for short-term situations such as intraday momentum trading. The 20 period EMA is this red one right here that you see. All right. So that's a 20 period EMA, and it is best for intraday momentum trading. Now, the next one that we've got is the 50 EMA. Now, the 50 EMA is going to be best for more stuff like medium-term situations such as swing trading or spotting entry signals. All right. Then next we've got the 100 period EMA, which is right below that, this blue one right here. And this one is best for intermediate or long-term situations and is best used to confirm the overall strength of a trend as well. Now, lastly, we have got the good old 200 EMA right down here, which is my purple line that I've got here. And this one is best for long-term situations and can also be used as major dynamic support as well. There's a lot of traders out there who use this 200 EMA for a good solid level of dynamic support. All right. So how do you actually go about reading these EMAs? Now, this is the part where a lot of people kind of do things a little bit differently. There realistically is no set way of how to read these EMAs. It's all based on how it overall intertwines with your personal trading strategy that you are using. But one of the most common ways to read these EMAs is actually by looking at the trend direction itself. For example, when all of the EMAs are stacked above one another, such as the 20 on top, which is what we got right here, the 20 on top, and then the 50 below, and then the 100 period below that, and then the 200 below that, in order just like this, then the trend is typically obviously bullish, as you can clearly see right here. All right. And the same is true in the opposite direction as well, and would signify a bearish trend. All right, let me go ahead and show you an example of that real quick. Where is a good solid bearish trend? You know what? Maybe I have to move to a different time frame to show you this because we have been bullish for a little bit here. All right, so we'll move to the 4 hour. Here we go. This is a good example right here. All right, so here we are in the 4 hour. Here is a bearish trend. We can clearly see that the EMAs are in the opposite direction. All right, when things are bearish, the price action is below all of the EMAs right here. We've got our 20 EMA here. We've got our 50 EMA here. We've got our 100 up here, and then we have got our 200 period up here. All right, now let's go ahead and go back to the daily chart. Let me go ahead and make this smaller here. And now, here's the thing, all right? If the EMAs are crisscrossing or close together, it also typically means that the market is currently consolidating as well. As you guys can clearly see what's going on right in here, okay? Price ended up coming down. All of the EMAs are kind of like jagged everywhere, kind of like a puzzle. I don't know, whatever. And that typically signifies that, there's a lot of indecision in the market and nobody knows what's going to happen here. But you can clearly tell that price had started to consolidate right around in this area here. And that's pretty much where all of the EMAs started to kind of go jagged with each other. I typically would not suggest trading these types of consolidations right here. You always want to wait for a very, very clear trend to start showing up, all right? Now, when it comes to actually trading with these EMAs, two common ways that traders trade with the EMAs are by one, using them as dynamic support and resistance, and with EMA crossovers as well, like I was just explaining. So when it comes to dynamic support and resistance, the overall purpose here is to use these EMAs as basically like, I guess you consider them as, like invisible zones or something like that when price typically has a reaction to it, okay? So what you want to do here is you want to watch how price action, meaning the candles themselves, you want to watch how the price action respects or rejects the EMAs, okay? Typically in a downtrend, the 50 EMA and the 100 EMA will often act as resistance, as a layer of resistance, all right? So let me go ahead and show you an example of that. So we're in a downtrend right here, and as you guys can clearly see right here, we did end up coming down right in here. Actually, here's a good example right in here too, except this one, let's see here. Yeah, so this one came all the way down to the 50, and then it came down to the 100. So as you guys can clearly see here, price action came all the way down to the 100, the 50 period EMA right in here, and that acted as good solid support right there. And then it bounced straight up, it got rejected all the way down here and shot straight back up. But then a couple days later it came back down and it hit it once again right down in here, all right? And then a couple days later, once again, it tested that same EMA once again, the 50 EMA right there. Now, over here, we got the same concept. It came right back down. It retested that 50 EMA once again. And then down here, we came back down. But this time, we came down and we tested the 100 period EMA right here. All right. But as you guys can clearly tell, this is kind of what I'm overall talking about here when I say that price typically respects or rejects these EMAs, all right? So typically in a downtrend, the 50 EMA or 100 EMA will often act as good solid support. And in an uptrend, when things are uptrending, the 20 or 50 EMA will act as support. And the way that you would trade this is by watching the candlesticks themselves, all right? So let's go ahead and go to a uptrend here. So here's a perfect example of an uptrend. We are starting this uptrend right in here, okay? And you can clearly see it right in here. Price came down. It came down to the 20 period EMA right in here, as you can clearly see, which is the red line. And then it did it again right here. And then it also did it again right here as well. All right, so that's kind of overall here what I'm talking about as far as when we are in an uptrend. The 20 or 50 EMA often acts as a good solid layer of support right there. All right, so for example, if price ends up breaking down, then rallies back to the 100 EMA and it gets rejected there, you want to open a short position, okay? The same is true in the opposite direction as well. For example, if price ends up rallying upwards, if it ends up rallying upwards and then it breaks down to the 20 or 50 EMA and then bounces it back up to the upside again, you typically want to open a long position, all right? That's pretty much what I'm talking about here when I discuss using these EMAs as overall dynamic support and resistance here, all right? So realistically, it takes a while to get used to watching the candlesticks themselves in relation to the position of the EMAs, but honestly, the more that you backtest and the more that you visually see it all firsthand, the easier it will be to see the best types of trends to trade, to be brutally honest with you, all right? Now, another way that you can trade with the EMAs is also by trading the crossovers, because the crossovers, they can help you to detect potential trend reversals or strong momentum shifts as well. So when it comes to crossovers, what you want to be looking for are both bullish and bearish crossovers. Okay. Bullish crossovers typically happen when the 20 EMA crosses above the 50 EMA. All right. So let's go ahead and go to our EMAs here, and let's go ahead and we're just going to turn off the 100 and the 200 EMA, and we're just going to take a look at the 50 and 20 period EMAs right here so I can show you, for example. Okay. So like I was saying, when it comes to crossovers, what you want to look for are both bullish and bearish crossovers here. Okay. Now, bullish crossovers typically happen when the 20 EMA crosses above the 50 EMA. All right, so we've got one right here. Okay, that right there tells us that we are insanely bullish right here. All right, and you can clearly see that that's going to happen before it actually happened as well. For instance, right here, both of the EMAs started to contract and get smaller and smaller. That tells us that, okay, there may be a solid move coming up here to the upside, and that's exactly what happened right here, and we got the cross right there. Now, I'll show you another example of a cross. We had another cross way down here as well. And since we created this cross right here, price ended up going up. I mean, Jesus, price ended up going up all kinds of percents. I'm not even going to measure that because it's all kinds of percents. But yeah, that's typically what I am talking about here when I mention that, you can look at the 20 and 50 crossovers to help guide you to decide whether, things are going to be bullish or bearish here as well. Now, a bearish crossover typically happens when the 20 period EMA crosses below the 50 period EMA. So it's the opposite of the bullish direction, okay? And to make this basic EMA strategy even better, you can add horizontal support and resistance levels as well, which will give you further confidence in the potential trade setups that you are looking at as well. But here is a good bearish cross example that I'm talking about here, all right? We had a 50 and we had a 20 and 50 cross right in here, and as you guys can clearly see, we ended up dropping a good amount from there. So from this moment here, we ended up dropping a total of around, let's see here, what is that? I don't know why I didn't just read that. Let's see here, we have got a total of 23%, 23.5% without leverage. Okay, so if you were trading that setup right there, that one simple setup right there on the daily chart, and you were trading it with like 5 or 10x leverage, we'll just say 10x leverage, you could have probably made over 200% right there very easily. So that's kind of what I am overall talking about here as far as being able to easily trade with these EMAs alone. All right. Now, something that I want you guys to remember is that no trading strategy is ever perfect, okay? There will always be risks that come with every trading strategy, and that includes using the EMAs as well. In fact, realistically, some of the most common mistakes that some traders make with the EMAs is 1, they try to trade every single crossover they see, and 2, ignoring the overall structure of the market as well, okay? And 3, overcomplicating the strategy with a billion other different indicators, okay? Something to always keep in mind with using the EMAs is that they're literally just tools, but overall here, EMAs can honestly really help you to understand overall trend direction. They can help you with timing your entries with precision. They can also help you with seeing the overall structure, of the market as well. But remember, realistically, no strategy in the world works all the time, all right? If every single strategy worked 24/7, literally every single trader would be rich, and that's just not the case. So you want to make sure that you combine your strategy with other layers of confirmation as well, which is why I mentioned stuff like support and resistance, or, maybe use another lagging indicator if you want, or if you're a fan of using indicators. You can use Fibonacci retracement levels. You can use all kinds of different things to confirm your overall bias. But regardless, you want to be confirming your overall bias, okay? So don't just look at these crosses and immediately think to yourself, oh, they're about to cross, so I should go long. No, you don't want to do that. You want to confirm that bias with another level to make your overall confidence in the trade much stronger, okay? Now, before I go ahead and wrap up this video, if you guys enjoyed this one and you feel like you got some decent value out of it, please be sure to go ahead and subscribe to the channel and hit the like button below the video. And hey guys, with that said, thank you all for watching.